My $17,250 gold price is as solid as can be. I mean, I'm convinced we will see this in the next, I say 3 years. Central banks now are the major players in the gold market. The gold market is climbing a wall of worry. 80% of the value of gold is tied to the US dollar. That the Federal Reserve is essentially monetizing the debt and printing dollars, and that's why the gold price is reacting the way it is. We saw a high of $5,400 gold in January. The gold production last year was about 3,800 tons. Well, almost half of that went to central banks. So they are like the number one players, and that's because they want their currency to be anchored closer to gold. Major client was first India, which used to take over 1,000 tons of gold just for jewelry. The central banks of China and Chinese people, just them, take over half the gold mined every year.
You kind of explained your $17,250 target for gold earlier this year. You tied it partly to the Dow to gold ratio. And in past cycles, that ratio kind of moved close to 1-to-1, but your base case was less extreme, a lower Dow, roughly a 2-to-1 ratio, and gold around 17,250. Is that still your working framework?
Yeah, absolutely. And the parallel between what we're living today and the 1970s, particularly the late 1970s, 1976, 1980, is incredible. And to use the French philosopher Voltaire, history never repeats itself, but man always does. And if you look at the 1930s, 50 years later, it was like the late 70s, early 80s. And then, 50 years later, we're looking at, again, the 26 to 2030 time frame. It seems that every 2.5 generations, we forget what happened. And if you look back to the late 1970s, you saw inflation go up every year. You saw interest rate go up every year. You saw the dollar go up every year. And guess what? You saw gold going up even faster every year until a peak of $800 in 1980. Yeah. Well, that was a tenfold increase from $90 back in 1975. And when I look at what's happening in the world today, the result of the Iran war first impact energy prices, which then impacts food prices. And don't be surprised if by year end this year, we see inflation CPI in the US at 4.5%.
Markets are celebrating soft landing headlines while energy-driven inflation is quietly rebuilding underneath the system. Pierre Lassonde notes that the late 1970s pattern was not just about inflation rising, it was about confidence in monetary control collapsing faster than policymakers admitted publicly. Oil shocks feeding directly into food and transport costs create second-order inflation that rate policy struggles to contain. Savers waiting for CPI confirmation usually realize too late that real purchasing power already disappeared months earlier. Next, Pierre Lassonde exposes why rising rates and a rising dollar can still coincide with an explosive gold move.
And again, it's a repeat of the 1970s. Now, in the 1970s, inflation went up to like 12 or 13, 14%, and mortgage rate went up to 17%. I don't expect that because back then there was very, very little leverage in the economy, very little debt. The total debt in 1981, when Reagan was first elected, was $1 trillion. Today, that's the amount of money that the US has to pay in interest every year because the total debt is approaching now 40 trillion. So the amount of leverage in the economy makes it, very, very difficult for the Federal Reserve to raise rates, which could complicate things even more to my mind. So I am I could not be more bullish, to be very honest with you. And what people tend to forget, I mean, the gold market is climbing a wall of worry. We've all heard about it. And I speak to, I was at a function this weekend. People were asking me about gold. They're all worried that it's, over, that it's too highly priced, it's going to go down. They don't realize that the world financial architecture is changing. And that's the reason why the gold price is so solidly anchored and very likely to go up.
Yeah, yeah. And I mean, you could point to, I mean, inflation week is also kicking off just this week with Morgan Stanley warning CPI could come in spicier, as they're calling it. And many expected, a hot April CPI tied partly to that energy and air travel.
The Federal Reserve cannot fight inflation the way it did in 1980 because the debt structure itself would break first. According to Pierre Lassonde, America now spends roughly what the entire national debt once totaled just servicing interest payments each year, exposing how trapped policymakers have become. Wall Street keeps framing gold as overcrowded while ignoring that real rates remain structurally fragile beneath the headlines. This does not punish hedge funds first. It erodes retirees, cash savers, and fixed income portfolios living on delayed inflation data. Next, Pierre Lassonde reveals why the system's leverage makes aggressive rate hikes politically impossible.
At the same time, the economy is still carrying enormous leverage across government debts, as you just talked about. I mean, consumers, private credit, corporate balance sheets. I guess my question is, if inflation stays sticky while growth kind of slows here, I mean, does that strengthen your 1970s framework? Or is today's setup more dangerous because of the system is far more leveraged?
Well, it's first you have to understand that 80% of the value of gold is tied to the US dollar. Okay, and then 20% is everything else, including interest rate, which determines the sort of variability of the gold price over, a short period of time. But the value of the dollar, in relationship with all the other currency, is the number one determinant of the gold price. And we just pointed out the U.S. debt 40 trillion. The U.S. deficit this year for 2026 will be over, I believe it's 7.9% of GDP. Imagine, I mean, this is the United States with budget deficit that used to be only allowed in Banana Republic. And next year is not going to be any better. And if you have a recession on top of that, what do you think is going to happen? Well, what happened is that the Federal Reserve is essentially monetizing the debt and printing dollars, and that's why the gold price is reacting the way it is. To me, and when we look at the short term, we saw a high of $5,400 gold in January. Then we went down to, like as low as 43, and even a bit lower, I think, and I think that was the bottom for this cycle.
The Fed says inflation is moderating, yet deficit spending now resembles emerging market crisis behavior more than reserve currency discipline. What Pierre Lassonde is highlighting is that gold's real driver is not jewelry demand or fear headlines. It is deteriorating confidence in long-term dollar credibility as deficits approach levels once associated with fiscal instability. Washington publicly defends the dollar while simultaneously expanding the conditions that historically debase it. Investors focused only on short-term pullbacks may miss that monetary expansion increasingly acts as a political necessity, not an emergency response. Next, Pierre Lassonde unravels why recession risk could accelerate debt monetization far faster than markets expect.
Now we're on the way back up.
Yeah, great to hear. When you're talking about that, roughly 80% of gold's value is tied to what happens to the U.S. dollar, and that debt load and that deficit trajectory this year are central to that kind of setup. If that's the case, is gold, less of a commodity trade and more of a vote on the U.S. fiscal credibility here?
It is. Gold, 90% of the time is a commodity, but 10% of the time it's the currency of last reserve. When the dollar doesn't perform its role as currency of last reserve, guess what? Gold takes its place. And that's what's happening right now. So I'm still incredibly positive about the United States and about, the US dollar. I just don't know when is that's going to happen. In the meantime, I see no will whatsoever, and that's why I'm betting on gold.
Yeah, yeah. You were talking about China there, and kind of that parallel payment system is compounding at the pace you were describing, 50, 100% every 6 months. That's not just, sanctions avoidance. It seems like that's a structural response to dollar weaponization. At what point does this become a liquidity problem for the dollar system itself, like where countries no longer just diversify reserves, but actively reduce their need to hold dollars for trade settlement?
That's a very good point, Jeremy, because as we are seeing, the central banks now are the major players in the gold market.
Central banks are buying gold while publicly defending the long-term strength of the dollar system. And that contradiction should concern investors. Pierre Lassonde's argument suggests gold is transitioning from a commodity trade into a referendum on sovereign credibility as parallel payment systems accelerate outside Washington's influence. Countries reducing trade settlement exposure to dollars weakens structural demand quietly over time, long before mainstream media frames it as a crisis. Retail investors watching daily price swings are missing the institutional repositioning happening underneath the global reserve system itself. Next, Pierre Lassonde reveals why central bank gold accumulation may signal preparation for a different monetary order entirely.
If you look at the gold production last year was about 3,800 tons. Well, almost half of that went to central banks. So they are like the number one players. And that's because they want their currency to be anchored closer to gold. And when you look at the reserve between the central bank reserve, it used to be 80+% dollars and gold was like, less than 10%. Well, gold has more than double in weight. It's now over 20%, while the dollar has come down to about 56%, and it's still going down. So the central banks are diversifying out of the dollars. They're, increasing their gold holdings. And on top of that, you have currencies that are popping up. You look at Tether, for example. Tether Gold, they're buying 3 tons of gold a month, and they have a currency that's like a world currency. They have 540 million wallets, 150, 60 billions behind it. That's becoming a world currency anchored on gold. So there's a lot of things going on in the gold world that have nothing to do with jewelry. I mean, like the jewelry market is a shadow of what it was 20 years ago. If I look at when I was chairman of the World Gold Council, our major client was first India, which used to take over 1,000 tons of gold just for jewelry. And second was, China, but way, after. Today, the central banks of China and the Chinese people, just them take over half the gold mined every year. So and then you got all the central banks from Poland to Azerbaijan.
Central banks are draining physical gold supply at the exact moment retail investors are being told inflation is under control. This is where Pierre Lassonde's thesis shifts from a commodity story into a monetary transition story, because nearly half of annual mine production now disappears into sovereign reserves instead of public markets. The real signal is not jewelry demand collapsing. It is governments quietly repositioning away from dollar dependence while alternative gold-backed settlement systems expand globally. Investors still treating gold like a short-term trade may miss the structural reserve shift already underway. Next, Pierre Lassonde reveals why Shanghai's growing control over price discovery could permanently alter volatility dynamics.
To, Russia, they're all buying gold to diversify out of the dollar. So, as I said, the entire world architecture of of finance is changing, and that's what we are looking at, and that's why I see the gold price, still going up over the next 2-3 years. And I reiterate that my $17,250 gold price is as solid as can be. I mean, I'm convinced we will see this in the next, I say 3 years, could be sooner,
Wow.
could be later, but, and that will be, depending on what happened to the Dow or whatever, it could be 2 to 1, 3 to 1. I don't want to be extreme because, like, if you look at 1 to 1, the Dow today is 50,000. Could that happen?
Mm.
I mean, anything can happen. The reality is that the gold price more and more is getting set in Shanghai on the Shanghai Gold Exchange. And we all know that, Chinese in particular have a very high propensity for gambling. And I said it when I was chair of the World Gold Council. What you're going to see at the end of this bull market is you're going to see essentially a casino type atmosphere in the gold space, and mostly that's going to come out of Shanghai.
Yeah, yeah. I want to talk to you about China. I have a couple of questions planned for it, but you just mentioned there briefly, Pierre, India, and it's obviously a major gold market. Just today, Prime Minister Modi is reportedly asking citizens to avoid buying gold for a year to protect foreign exchange rates, or reserves, rather. I mean, this is extraordinary. Does this prove your point that gold is no longer just a cultural savings asset, but a national balance of payments issue?
When governments start discouraging gold ownership, it usually signals concern about currency stability rather than confidence in it. Pierre Lassonde notes that gold pricing power is steadily migrating eastward towards Shanghai, where speculative behavior and physical demand increasingly overpower Western paper markets. Public officials frame gold buying as economically disruptive, while central banks themselves continue accumulating it aggressively behind the scenes. That contradiction matters because ordinary savers are being told to avoid the very asset institutions appear to trust most during monetary uncertainty. Next, Pierre Lassonde exposes why India's attempt to suppress gold demand may actually accelerate physical accumulation even faster.
Well, for India, it really is. It's their second largest purchase after oil. Okay, so Modi is on his knees asking his resident, but what do you think they're gonna, think when your president tells you not to buy something? They're gonna say, well, he's gonna depreciate our currency even more, and it's gonna have the complete total opposite effect. Okay, the demand for gold is gonna go up, and in India, they have a lot of backdoor to the official, way for entering gold. There's a lot of it comes in through the Middle East, on feluccas and different means, and that's what's going to happen. So now, the Iran war has caused a bit of a tremor in the market because, I mean, between Iran and in the Middle East, they are major gold purchaser, gold players, and that has been severely disrupted. But notwithstanding that, the gold market, maybe had a slight hiccup, but it's just, digested it and moving right on.
You talked about central banks picking it up, and obviously a major theme driving physical demand is this relentless central bank buying, especially from the East. You made an important point earlier this year. China has restricted crypto, so the Chinese investors looking for an alternative to the renminbi, gold becomes kind of the natural outlet here. Is that one reason price discovery is migrating east faster than Western investors understand?
I don't know whether or not it has anything to do with crypto, to be honest with you. Okay. Well, the fact is that, crypto are banned in China.
Governments only beg citizens not to buy gold when confidence in the currency system is already becoming fragile. According to Pierre Lassonde, India's dependence on imported gold has become so economically sensitive that policymakers now fear household demand itself could pressure national reserves further. But attempts to suppress ownership often create the opposite psychological reaction, especially in countries where gold historically functions as financial insurance outside official banking systems. Investors should pay attention to what populations do during monetary stress, not just what finance ministers say at press conferences. Next, Pierre Lassonde unravels why Eastern demand keeps overpowering geopolitical disruptions that should theoretically weaken gold.
So if you want to diversify gold, in terms of asset, gold is a natural, but it's been that way for hundreds of years. It's not nothing new to the Chinese, and so I see that as just a natural way for for gold. I remember visiting in Beijing. There's a gold store that's like 3-story high. All they sell is gold in every shape, form, from jewelry to bars to decorations to eagles to whatnot. And I asked the manager, I said, like, when people come here, do they buy the gold bracelet or necklace, earring, because it's jewelry or because it's an investment? And she goes, no, no, they buy it because it's jewelry. But in the back of their mind, if anything goes wrong, it becomes an investment.
Yeah, yeah. And of course, I mean, you warned about it just there, that as Shanghai becomes more important, gold could almost kind of trade with a more of a casino style mentality, as you call it. Does that Eastern price discovery make gold more fundamentally anchored or more volatile?
More volatile. We're seeing it in the price volatility. Like, in the morning, for example, the gold can be up or down $100 because of Shanghai. And then the relays gets on when London starts in the morning. And then the COMEX in New York. And it's a battle between the three. But, where the majority of the physical gold ends up, it's Shanghai, it's China.
Gold can swing $100 overnight, now because pricing power is increasingly following physical demand, not Western financial narratives. What Pierre Lassonde is highlighting is that Chinese gold ownership operates with a dual psychology: luxury during stability, monetary protection during uncertainty, creating persistent underlying demand that paper traders underestimate. Western analysts still treat Shanghai volatility as irrational speculation, while ignoring that the actual metal consistently flows eastward after price corrections. For long-term holders, the bigger risk may not be volatility itself, but misunderstanding who truly controls global price discovery now. Next, Pierre Lassonde reveals why physical settlement is quietly overpowering paper market influence.
And, whoever buys that last ounce of physical gold is the one who dictates the price.
I mean, it's a good point. I mean, all of that kind of points to that bigger shift from paper exposure to the physical control too. I mean, so it sounds like we're moving into a market where COMEX in London still set maybe the screen price, but the real power sits with whoever can source and hold the physical metal itself.
Yeah, and we see that in the silver space even more. And we saw, for example, that one trader on the Shanghai exchange, made like $500 million profit on the silver because he squeezed, like he cornered the market and then he dropped it, and they're able to. I wouldn't call it manipulate, but it's let's say a very concerted effort. Okay, let's call it this way. The gold market is so much bigger that it's very difficult for anyone to do that. But if you come in and you dump 200 tons of gold in the morning, the price will be down $100. When I was chair of the World Gold Council, I asked to do a study on the volatility of gold price vis-a-vis the quantity and the elasticity of gold price, if I can say that. And for every 100 tons of gold that is either bought or sold, the gold price moves by $40-50 a ton. So you can see, like, not a ton, per 100 tons, sorry.
Right.
So you can see, like, if you're 200 ton, that's $100 for sure, that volatility. And that's the kind of, volume and volatility that we're seeing today.
Markets appear liquid until physical demand suddenly overwhelms the paper promises backing the system. Pierre Lassonde's argument suggests a real battle is no longer between bullish and bearish traders, but between synthetic exposure and actual metal ownership as physical buyers increasingly dictate settlement pressure. A single concentrated move in silver already demonstrated how quickly thin liquidity can create violent repricing events beneath calm market headlines. Investors relying entirely on ETFs or derivative exposure may discover during stress that access to metal matters more than theoretical portfolio allocation percentages.